Okay, let's go ahead and get started. I'm going to start with a little background story about myself before I share my slides. And one of the biggest memories that I have is sitting at the kitchen table with my parents, eating mom's meatloaf and potatoes. And I set my fork down because I had a question on my mind. So finally, I look up and I say, Dad, when are you going to retire? He kind of put his hand to his head and did one of these, like, and sat back in his chair. And he said, well, the markets are still down, so I have to work a few more years. And it was at that point that my heart sank. This was a man that had been working for over 30 years in a dirty job doing waste management for the city of Cincinnati. He had been taught to invest in stocks and mutual funds his whole career, and that was supposed to provide for him in retirement, and that's exactly what he did. But this was 2009, and the markets were still rattled by the '08 crash, so he was now handcuffed to his job. And as my mom and I were clearing the dishes, all I could think to myself was, I don't know what I'm going to do different, but I'm not going to have my retirement years taken away from me like that. So fast forward a few years, my husband and I, Adam, we were living in Southern California on a work assignment, and he invites me to a investing class after work one day. So I meet him there after work, go to the hotel venue, go to the front desk, and I asked the gentleman where the investing class was. He says, do you mean the real estate class? And I'm like, no, I mean the investing class. And he's like, well, we only have a real estate class tonight, and it's on the 3rd floor. So I'm a little confused, but I head to the elevators, go up there, and I exit the elevator, and I see Adam standing there in front of the conference room. And I go up to him, I'm like, what are we doing here? Like, I've never invested in real estate. I don't know anything about investing in real estate. And he kind of just smiles and pushes it, puts his hand on my back and says, just come in and listen. Just listen. So I really doubted being there. I thought about driving home, but in LA traffic, it would take longer to drive home than it would to just stay and go home afterwards. So I stayed and I listened. And that 2-hour class changed our lives. It empowered us with knowledge of how real estate can lead to financial freedom, financial security, how it can grow your financials. Adam and I looked at each other afterwards, and we were so amped up. We were like, this is it. This is what we've been looking for. This is what's going to make a difference in our lives. And I drove home that night, and all I could think about was, man, I wish my dad would have had an opportunity like this, or would have learned about something like this, because it could have prevented him from working for 35 years in a physically demanding job. Adam and I started investing in apartments 5 years ago, a short 5 years ago. And like many of you may do, we started with passive investing. So we started with silently investing in other people's deals. And that money has already snowballed to be substantial passive income in just 5 years. And I'm going to share my numbers here in a few minutes. That's income that we don't have to work for, income that we will make when we're sleeping, and income that we'll make when we're on vacation. Passive income. My name is Emily Courtwright, and I believe that everyone on this call has the ability to look up in 5, 10, 15 years from now and be massively wealthier than you ever imagined by investing in real estate and apartments. Over the past 5 years, Adam and I have helped over 900 people start or continue their investing journey by providing opportunities for apartment investments for them to join us on. So in the next 45 minutes, I'm going to teach you the fundamentals of apartment investing. So we're going to jump in. The first one is going to be principles. let me go ahead and share my screen. Okay, can I get a thumbs up if you can see my screen? Perfect. Great. Okay, so we are going to jump in. Principles. The reason we are talking about this today is because it's important for you to understand the strategy and the benefits of apartment investing. Let me get my screen to where I need it to be. 1 second. Okay. Let's jump in. The strategy that we do is we do shorter term investments. And everybody else may be telling you to invest for the long term, and I'm telling you to invest for the short term. And when I say short term, I mean around 5 years or less, because that is the strategy that we have used to create massive gains in net worth and capital and net passive income for ourselves. So let's talk about the strategy. First, we buy the property. And we strategically buy them in landlord-friendly markets, places where there is high population growth, high job growth, and places where there tends to be an affordable housing shortage. So I'm very fortunate to be located in the Dallas-Fort Worth Metroplex, and Dallas-Fort Worth meets all of those line items. There are a lot of different markets that meet those line items as well. But DFW is what I focus on because I live here. And it's easy for me to be at the property and be present and really have a great knowledge of the different submarkets by investing in my backyard. The second step we do is we improve the properties. And we'll give an example of this later, but the biggest thing is interior renovations. 5 years ago, HGTV had tan walls and brown floors, and now it's gray walls and grayish wood flooring. So there's always going to be design changes, and we tend to see those every 5 years or so. The other thing that we do to improve the properties is we are offering different amenities. And some of the major amenities today that we're seeing are smart technology. So we'll put a Ring doorbell, a smart lock, and a smart thermostat on an apartment unit, and tenants will pay an additional $50 a month for a smart apartment unit. Another thing we're doing is we are offering Amazon package lockers on site to avoid any issues with packages being stolen off people's front doorsteps. We are also offering laundry machines for rent. So if most millennials don't own washer and dryers. So when they come and live in our apartment, they can rent a washer and dryer set for $40 a month. So there's different amenity streams that we can offer to increase our income. We are also trying to optimize our expenses. So we are not slumlords. We are not slashing expenses by any means, but we are optimizing them. And that typically takes the form of renegotiating contracts. So we have contracts with the dumpster companies. We have contracts with the landscapers. We have contracts with pest control. And a lot of times when we buy the properties, the sellers have kind of taken their foot off the gas in terms of contract negotiations. So that's one of the biggest areas that we see in terms of optimizing the expenses. Now, once we've increased the income and we've optimized the expenses, we then look at the ability to sell or refinance. And that hold period, we really try to optimize. So when we do our initial analysis, we are always planning on a 5-year hold. So the spreadsheet says it's going to take 5 years to get to where we can resell it for amazing gains and everybody wins. Now, the past 5 years, we have been able to sell sooner. So we've been able to sell at 3 years. Now, I can't guarantee past performance, does not guarantee future performance. So I'm still going to say plan on a 5-year investment. And then once that property sells or refinances, the gains are then returned to the investors. So what do you do with the gains? Well, the strategy that I've done that's allowed me to grow my net worth substantially and grow our passive income has been to reinvest those gains. And there's 2 reasons for that. One, you get to compound the returns. So let's just say you double your money every 5 years for easy numbers. You put in 100, it turns into 200, 200 turns into 400, 400 turns into 800. And when that time is actually compressed and it's not 5 years and it's really sometimes 3 or 4, the numbers get even bigger in a shorter amount of time. The other reason we are reinvesting is because it's going to give us the maximum tax benefits. We'll talk a little bit more about taxes in a minute, but when you sell and there is a gain, one way to offset those gains is to reinvest and get depreciation from the next deal to offset those gains. And I'm not a CPA, so please double check with your CPA. But basically, this strategy done over and over again is what has allowed us to 10x our net worth in under 10 years. And we've done this strategy with single family, with our flips. We've done it with rentals that we've held for 3-4 years. And then we realize that the whole period has been optimized. And we go ahead and sell, we cash out, and we reinvest those funds. So our net worth started around $350,000 in 2013. That's when Adam and I started tracking our expenses and our net worth. And now it's up to almost $5 million by doing this strategy. And I can't, I have big dreams of what that net worth number is going to be in 20 years from now. But this is an important part of the aspect of the strategy, because these are not long-term buy and hold deals. These are properties that we plan to buy, improve, and exit as soon as we can essentially double investors' money. So I'm gonna be open book, and I want to share my passive income journey, which started in 2017. And if you can see in 2017, which isn't, I forgot to put the label on there, we invested $65,000. And that started slow. Real estate, it's not a get rich quick, it's a get rich for sure kind of game. So we invested $65,000 in 2017. In 2018, we doubled down and we invested $200. In 2019, we invested another $100. And if 2020 hit and our cash flow, our passive income took a little dip because properties paused distributions during COVID. But then in 2021, they jumped back up. And then this past year, 2022, we had 3 of our passive investments sell. And this was our passive income in 2022 was almost $260,000. Now, what did we do with that? We reinvested it all, because that's not money that I need to buy groceries or pay my mortgage. It's money that has been set aside for investing that is there to grow. So right now we're invested in 17 passive investments. And my goal is to set myself up where every year looks like 2022 or better. So every year we should have a few deals selling, and then we'll just keep recycling that money over and over and over again. So let's talk about some of the benefits of multifamily in general. The first one is valuation. And we all know that single family is valued based on comps. So there's an ability to over improve a house if the comps do not support. Well, in multifamily, it is valued like a business. And a business is valued on the bottom line income, which is why it's so important to increase the income and optimize the expenses, because when we increase the bottom line, we are increasing the value of the apartment complex. So I could have 2 apartment complexes right next door to each other. They look the exact same, but one brings in more income and it will be worth more money. So it's all based on how much bottom line income the property brings in. And I'll give you some examples of this in a few minutes. The next one is tax advantages. And again, I'm not a CPA, please consult your CPA, but we use depreciation in multifamily, and these are large properties. So they give off a lot of depreciation, and it is split up between all the passive investors. And those depreciation losses in the first year can help offset any other passive income that you have. And again, depending on your tax professional status, it may be able to offset other items. But I'll give you a specific example. In 2018, I sold 3 of my single family rentals. I made 300,000, so 100 on each. And I reinvested all that money into multifamily. When I got, for 2018's taxes, multifamily gave me a negative $300,000 loss. So my depreciation loss from my multifamily investments completely offset my single family home sales from that year. And that's something we can talk about one-on-one. If you are selling assets this year and you need to reinvest funds to get losses and offset those gains, multifamily is a great strategy to help do that. So let's talk about the cash flow and capital gains. We target after 6 months to start monthly distributions. So we give ourselves 6 months to implement a lot of the construction projects, get the property really stabilized to our vision plan. And then depending on the property's performance, we start doing monthly distributions, monthly cash flow back to your accounts as a passive investor. The hold time, like I said, is planned on 5 years. That doesn't mean it's set in stone. It means that we will sell sooner if we can. And if the market, if we can't, and worst case, we have to hold it 1 or 2 more years, we will optimize that hold period. But the point is we will sell as soon as we can essentially double investors' money, because we want to be able to maximize our compounding interest and reinvesting. Now, different deals have different strategies. And typically when we see a very good cash flowing deal, there's a little bit less gain on the back end. And it's kind of inverse. If a property doesn't cash flow very well, then the gain on the back end is probably a lot higher. And so there's different strategies, that every property is different. Every property has its own story. So you would have the opportunity to review the property itself that was being invested in to see if it was right for your portfolio. Another benefit is control. And the story that comes to mind to me is when I started working full-time after college, it was with GE, General Electric, and they want you to pick your benefits packet. Like, what do you want your company match to go to, the mutual funds and stocks and things like that. And my dad at the time told me, oh, invest in GE stock, right? Because that's all he knew, like invest in stocks and mutual funds. And so I just literally like picked some, like I had no idea what they were. And I had no control over how they performed. I have no control over GE stock and whether it tanks or whether it does great. But in multifamily, we have a lot of control as the owners on how we adjust our strategies to different market changes. So when COVID hit, we adjusted our strategy. We worked very, very closely with the property management. Today, there could be a little bit of change in the market, and we will continue to work very, very closely with the property management. So there's a lot of control. And again, that's another reason I like to invest in my backyard, because I can literally drive to the properties. I can see if the curb appeal is there. I can see if the property management has taken their foot off the gas. The last benefit is improving the communities. And this is kind of the heartfelt one, because we as the owners, we get to dictate how involved our property management company is with the tenants. And we tell them we want one tenant event per month at least, because we want to build community. An apartment complex where people love to live, where they invite their friends and their family members to live near them, is our goal. Because when they love to live there, they won't want to leave. And that has been an amazing part of apartment investing, is just seeing the impact on the communities that you can have. So a quick lesson on the classes of multifamily. The first one is Class A, and that is typically luxury apartments and built, I would say, 2010 or later. Class B is built in the 80s, 90s, early 2000s, really, affordable, working class, but nice properties. Class C, typically built in the 60s or 70s, very much a working class apartment complex. We see, typical incomes around that 30 to 50,000 range. And then you have Class D, which stands for do not buy. This is not a class that we invest in at all. We stick to Class A, B, and C, and not necessarily the new build A. It's more like the 2010, 2009 A class, because we want to stick to apartments that are affordable for the majority of the general public. And that's another strategy. I don't necessarily want to buy a new build Class A where the rents are $3,000 for a 2-bedroom or $2,500 for a 1-bedroom. I want to be in the affordable range where the maximum amount of people can afford to live there. So let's go to the next topic. And the next topic we're going to talk about is the power of leverage. And the reason we're talking about this is because it's what makes the group purchasing so unique in what we're doing. And it's a really important aspect of understanding how this all works. So how many people have heard of the term OPM, other people's money? And when you talk about investing and you start getting more in tune to investing strategies, you'll hear about the term OPM, other people's money, a lot. And multifamily is an amazing example where we leverage other people's money to buy apartment complexes that we can't afford on our own. So we are buying anywhere from 100 to 350 units, anywhere from $10 million to $50 million, $60 million apartment complexes. Even on a $10 million apartment complex, I do not have $3 million to spend on a down payment. I need to do a group purchasing model, and it allows for leverage. We use leverage in our businesses. We leverage out our time. We leverage out a lot of different parts of our business. This is leveraging other people's money. And it allows a group of investors to come together and purchase a property as a single entity. And as you can see, we would still get a loan on the property. So the loan would cover, in this example, $7 million. And then the $3 million would be raised from a group of investors. So let's take that one more step and kind of show the different roles and responsibilities. Because the next part of it involves leveraging other people's time, OPT. That one's not as common as other people's money, but leveraging other people's time is another important aspect. So let's look at the two different categories of investors that we have in our group. We have the passive investors, also called the silent investors, and they're also called the limited partners. So the passive investors, they literally do not do anything. They do not have any day-to-day responsibilities. They do not have to answer calls about maintenance. They do not have to deal with evictions. They do not have to deal with color choices on what color are we painting the walls or what's the new flooring going to look like. They are silent or passive in these projects. Now let's jump over to the deal sponsor side, which is what I would be. I'm a deal sponsor or a lead investor, also called a general partner. Now, what are my responsibilities? Me and my husband and our team, our responsibilities are everything. We go find the deal, we analyze the deals, we tour the deals, we make offers on the deals, we get the deal under contract, we work with the lender, we manage the deal, we close it, we implement the vision and the business plan, we optimize the exit strategy, we do all of it. And for all of that work, we are given anywhere from 10 to 30% of the ownership of the property. And then the passive investors have the rest of that ownership. Now, the typical investment that we see from a passive investor ranges between 50 and 100,000. That's typical. It can be higher and sometimes it can be lower, but it depends on the property. Never be afraid to ask for lower, but typically 50 to 100,000. And this is the epitome of leveraging other people's time, because the passive investors, if you think about going to buy a rental property in a normal market in the US, your down payment is probably going to be somewhere between $50,000 and $75,000, maybe even $100,000. If it's a $300,000 rental and they want 30% down, it's going to be close to $100,000. And then you still have to manage it, and then or work with the property management company. For that same investment, you can invest it completely hands-off and be completely passive. So you're leveraging the deal sponsor's time to create an investment, create a passive income stream, and we are leveraging other people's money to be able to buy these properties as group purchases. So it's really a win-win from both sides. The next topic we're going to talk about is preparation, because there are a lot of people doing what I do across the US, and you just maybe haven't met them yet. So there's a lot of opportunities to invest passively, and whether it's with me or with other people, I want to talk about kind of the mentality that you should have when you approach it. The preparation is really the who are you going to invest with, what are you going to invest in, and where. And those are the three important pieces of the puzzle. So I'm going to, as I talk about my side from the who, these would be some of the questions you would want to ask another a lead investor or a deal sponsor if you were being approached to invest with somebody else. So first, you want to understand their background. Personally, my husband and I, we have bought 8 large multifamily, like I said, ranging from 117 to 324 units. We've sold 2 of them. So 2 of them have already gone full cycle. And we now have 6 under management. Those 6 total about 200 million in value. And like I said, I am also a passive investor. So I invest passively in other markets. That's one way I diversify. I'm invested passively in Atlanta and Colorado and Phoenix and other markets throughout Texas. It doesn't mean that I have to buy them there, but I can invest passively in other markets. And that is one big way that we diversify our portfolio of passive investments. I've been a single family investor since 2013. It has culminated to where we are today. And then with my office, I am on the ALC, and I also lead our culture committee. So that's a quick background. I want to tell you a little bit more about my team, because these are large, we are operating businesses. So I operate 6 different businesses. Each apartment complex has its own business, and this is a team sport. So I can't do it alone. Our partners, Bonnie and Carrie Staples, are the other lead deal sponsors with us. One of the reasons we chose to partner with them was because they are one of the best in our industry. They actually just last year won the National Apartment Association's Small Community of the Year Award for one of their properties in Houston. They love on their properties, and they have created amazing returns for their investors. They are the best. So we sought them out, and we said, these are the people that we need to partner with. We hired a regional manager last year. So Ruth is boots on the ground with us here in Dallas, and she helps us oversee the properties. And then we have 3 full-time assistants that do executive assistant work and transaction coordination. The second thing you need to ask about is track record, because track record is so important. And I'm going to tell you a quick story before I jump into this, because when we got started in multifamily investing, I was so excited. And I went to my first multifamily event, and I met a whole lot of people. And literally the first 3 deals that came in my inbox, I invested in. And that was the wrong thing to do. I didn't know the people very well. And luckily, 2 of the first 3 worked out great. But one of them was I'll call it worst performer in my portfolio. And it's because of the people. I didn't check their track record. They had bought a lot, but they hadn't sold any. And they were disconnected. They actually ended up leaving they moved out of the United States. Their property was here in Fort Worth, and it was a great property, but the people weren't the right people for the job. And again, it was the biggest lesson learned that I've experienced throughout my time in multifamily, and it's a mistake that I'll never make again. I will always make sure that the person I invest with has a track record. Now, it doesn't mean that you shouldn't invest with, like, I was brand new at one time, so I have to think about this. I was brand new at one time, but I partnered with a very experienced partner that had the experience. And so I encourage you to check on track record before you make an investment like this. So we have 960 investors throughout our deals that we have right now. The average annual return from the two that we've sold has been 26%. And that's, I think Warren Buffett, his minimum is 20% annual return. So this would have met Warren Buffett's criteria. But what does that look like in terms of dollar numbers? That looks like if somebody invested 100,000, they got back 180. So they made $80,000 profit off of their $100,000 investment. And the average hold time you see here was 3 years. Again, this was in the past. Can't guarantee that going forward. But based on the two that we've sold, it was an average of an 80% total return in only 3 years. And so pretty much 80 divided by 3 is around that 26% number, average annual return. Let's talk about a case study. So the first one is North Haven Terrace. This is a C-class property. You can kind of see it's a little bit older. It was built in 1968, very much a working class property here in Dallas. And this property we bought in 2019. We raised $5.9 million for the down payment. And that was ended up being a group of 77 passive investors. So the group of 77 of us bought this property. My husband and I led the improvement efforts, which I'll show you an example of on the next slide. And within 3 years, we were able to sell it we bought at 21, we sold at 32 million because we increased the bottom line income of the property. So this one was actually a 130% total return. So if somebody invested 100,000, they got back 230, including their initial 100. So let's talk about some of the improvement projects we did. The one that had the biggest impact was water conservation. And what we did is we installed low flow toilets across the entire property. And we also installed low flow shower heads. Now, when we were doing our inspections and we were walking units, it was kind of sad because every other unit, it seemed like that we walked into, the toilet was running, like the flapper seal was broken, or the shower head was dripping, or the faucets were dripping. You could just see a huge amount of waste happening in terms of water being wasted. And this property in particular is all bills paid. And that means that the tenants do not pay the bills. The owners do. We just add money to the rent to cover the bills. So we paid the water bill every month. And as soon as we took ownership, we hired a company to come in and change out all the shower heads and the faucets and the area and the shower heads and the toilets. It cost us $110,000 for that project, but it ended up saving us $120,000 a year. We cut our water bills in half. Now, this savings of $120,000 a year, when you value that like a business is valued today, that's almost $3 million of value just from that project, just from spending $110,000 on water conservation. Another example is reserved parking. And this is an example where you literally take spray paint and you spray reserved on the asphalt. The cost is almost zero. And we can, at first, we charged $35 a spot. Now we are up to $50 a spot. So we were bringing in an extra $50,000 a year of income just by implementing a reserved parking program for almost no money out of pocket. It's projects like these that increase the value of the apartment complexes and allow you to sell them within 5 years for huge profits. Let's go on to the next example. So this one is Eagles Point. This would be a B-class property, more B-class, built in '86. It's located in Fort Worth, 240 units. And you can see from the pictures, it's definitely a nicer property. It's a nicer demographic than North Haven Terrace caters to. Now, this one we bought for $31.5 million. And we had to raise $12 million for the down payment. So this group of investors is bigger. This is 147 passive investors together. We came together to buy this property. This one cash flowed at 6% the first year, starting from the first year, and it's already valued over $40 million. This one we will probably sell if, depending on how the market, again, we optimize our hold period. So right now is not a great time to sell. The buyers can't get very good interest rates. So I'm going to hold it till, I'm going to reevaluate in summer, maybe end of the year, maybe early next year. But whenever the market is ripe for selling, we will sell and exit this property and return gains back to our investors. The third thing I want you to ask about, if you are talking to another potential lead investor or deal sponsor in any type of investment, is testimonials. Testimonials are so important. To talk to people that have invested with them before. Ask them how their communication is. Ask them if they've made any returns. Have they given you money, any money back? Do they make distributions? How is the process? Get a baseline and ask for a testimonial. So this is actually my Aunt Jill. This is my mom's sister. Her and her husband, Rich, live in Fort Lauderdale. And Jill works at a software company, and Uncle Rich is he's a handyman. He just does handyman work for neighbors and different neighborhoods around him. And they were so discouraged with their stock market and mutual fund performance that when I started getting into real estate investing, they started asking questions. And our very first multifamily deal, they invested in. They've invested in 6 of the 8 so far. And because they were in the 2 that sold, they were able to fund one of their dream vacations to go to Spain together. And it's amazing to see. And honestly, we have a lot of family members that invest with us. My in-laws, my cousins, my aunts and uncles, Adam's sister. When there are family members that invest in your deals, it's an even higher level of responsibility for us. We take the responsibility very seriously. We have coaching to do what we do. We have a peer group to do what we do. We have mentors that guide us during economic changes. We take it very seriously that we are managing other people's money, essentially. And the responsibility is even higher because we have family members that invest with us. That would be a really awkward Thanksgiving if like one of my properties didn't do well. So we do hold ourselves to a very high regard in that terms. So some of the common questions that I get. The first one is, what funds can I use? And the answer is there's a lot of different options. You can use cash. You can invest with entities, partnerships, LLCs. We do have a lot of investors that invest with family trusts or self-directed IRA. or, different IRA accounts, self-directed, where you have either checkbook control or you can invest in real estate. You can also invest as a combination. So we have a lot of people where their first investment is maybe half from cash and half from an entity, or half from a self-directed IRA. And that's very normal and typical and allowed. Do I have to be accredited? The answer is no. With the types of raises that we're doing and equity raises, you do not have to be an accredited investor. Now, on the flip side, you do have to be in our investor database, because the rules that we have to follow under the SEC is that we cannot blast out our opportunities to the public. I cannot blast it on Facebook. I cannot say, I got a property under contract, who wants to invest with me? I can only blast it to my investor database, people that I know or I have created a relationship with. So the only people that get the email when we have a property that we get under contract is my investor database. And I'll tell you at the end how to take that next step and get on the investor database. And then the next question I get is, when is the next opportunity? And this goes a little bit into process and preparation, because our goal this year is to buy 3 properties. So I will likely have 3 opportunities to invest this year. And let's say the first one comes in the spring. If the timing's not right for you, that's fine. There will be another one later in the year. And if that time is not right for you, there will be another one later, probably later in the year. That being said, we do not raise funds before we have a property under contract. So once I get a property under contract, that is when we start sending emails to the database saying, hey, we've got one. In about 2 weeks, all the legal docs will be ready. You'll be able to review all the details. Here's some teaser information. And that starts that ball rolling for the process and the timeline of raising funds. So every property that we raise funds for is its own investment, and it's for that particular property. For like North Haven Terrace investors are completely separate from Eagle Point investors, if that makes sense. I can answer any questions one-on-one if you have other questions about that. So let's talk about why now. And I think this year is going to be a really interesting time when this is what the experts are telling us, and the lenders too. There is an opportunity this year for us to get properties at prices that we haven't seen for a few years. Like prices that I was paying in 2021 and 2020, and even before that, is what we're supposed to see this year. And the reason is because there were some people that were not smart about how they purchased their properties. They bought them on a variable interest rate without putting in some safety nets. And when they bought it, their interest rate was 2.5, and now their interest rate is 7.5, and they cannot afford their mortgage. There are companies that invested in apartments, and they had one large equity investor. So one company brought all the down payment, and that company wants their money back. We've already seen 2 listings like that come out, where the equity partner wants out. So the deal sponsor, the lead, has to sell because their partner wants their money back. So we are already starting to see, I'll call it motivated seller listings in the apartment community. And the lenders tell us it's just going to get worse because they can see the loans that have been done, and they can see when these apartment owners are going to not be able to afford their payment anymore. So this is a really unique opportunity, and 3 is my estimate. It could be more, it could be less, but we are ready to capitalize on properties and buy this year. Again, we're in DFW. It's not very often that you see prices tick down a little bit And so I want to take advantage of that and then ride the market as it goes up over the next few years. So one of the most common questions I get is, Emily, can you help me get started in apartment investing or get started with my passive income journey? And the answer is yes. The next step for you is to schedule a 30-minute passive income call with me. And this call will allow you to get in my investor database. We can talk about other passive income streams that you may be interested in. But it'll allow you to invest in any of our future opportunities if the timing is right for you and if that's what you decide you want to do. I invite you to scan the QR code, or you can visit my Calendly link. Picture a day when your first apartment investment sells and that chunk of money hits your bank account. Picture a day when your partner comes to you and says, let's take that dream vacation. Picture a day when you can have the freedom to live life on your own terms. Whether you have never invested before, whether you have a small portfolio, or whether you are a seasoned investor, our 30 minutes together can help take your investing to the next level. I have one final thought to share. My dad was finally able to retire, and for years, the stock markets went up after that until COVID hit. And when COVID hit, he was reminded again that his nest egg was completely out of his control. It was that event that got him to start asking us questions. He had seen us investing in real estate for almost 10 years, and he finally started asking questions. And I am so proud to say that at 72 years old, my dad made his first apartment investment, his first real estate investment of his life in one of our deals last year. It took him 72 years to decide to do something different with his finances. But it's the decision to change, the decision to do something different that is the secret to success and the first step towards your financial freedom. You deserve financial freedom where you don't have to worry if the markets are up or down. You deserve financial freedom where there's no limit to the quality time that you can spend with your family. And you deserve financial freedom where you can live every day to the fullest. You deserve financial freedom. And I invite you to come invest with me in apartments, and we can all get there together. So at this point, I want to open it up for Q&A. And I'm going to see if I can see the chat box, or just unmute yourself. This is open.
Anyone online have questions?
So we got a question come in, and this is a very common question. Do we purchase the properties under an LLC? And the answer is yes. That is exactly how we are purchasing them. We buy them under an LLC, and then the investors buy shares of the LLC. Then the LLC buys the property. So you don't, let's say it's a 200 unit, you don't own like unit 102 and 103. You own shares of the LLC. What other questions do we have?
Hey, Emily, I have a quick question.
Yeah.
You mentioned once you find the property and get it under contract, you then are going out to investors and trying to raise money for the deal, right?
Mm-hmm.
I guess, and I'm very new to this, and I've only worked on the residential side. But typically we have to show like proof of funds before you purchase and do all that. I guess, how are you funding the deal to purchase it prior to raising the funds to go through with everything?
That's a great question. And the question is, how do we get these deals under contract without having proof of funds? And in the multifamily world, in large commercial properties, this is a very typical strategy. So when we talk to the brokers, and let's say we're in that final round, we fill out what's called a buyer questionnaire. And the seller is essentially asking for our resume. And we put on there what he wants to know. Let's say we have to raise $10 million. He wants to know, when was the last time you raised $10 million? Have you had any issues raising $10 million in the past? And he asks us these kind of questions to make sure that we have the capability to raise the funds. The other point to make there is that the closings are longer for multifamily than they are in single family. So we typically have anywhere from 60 to 90 days to close. And so in between there, from the day we get it under contract, usually within 2 weeks, we start our equity raise. And then that gives us essentially 45 days at minimum before closing to raise the funds. Okay, here's another question. Let me get the chat. Okay. How long do you write your contracts? Okay, so the contracts are written for 60 to 90 days. Do you start with a specific sum of, how do you fund your first building? So we partnered the first time, the first large multifamily for us was 180 units. Like it's like go big or go home, because it takes the same amount of effort to lead a 100 unit apartment complex than it does a 180 unit. But we partnered with a very experienced person. And so going back to Garrett's question, when we presented our resume to the selling broker, the listing broker, and the seller, our resume was literally all of our partners' information, like, because we had zero multifamily experience back in 2017, 2018. And so our partner was the one that raised the majority of the funds on that first deal. Today, we are raising $5-6 million just ourselves for each deal. And then we have our Bonnie and Carrier, our partners, and they also raise funds for each property. So how did you learn all this? Think about MAPS coaching, and agents hire a MAPS coach to accelerate their business. I hired a coach. It wasn't a MAPS coach. It was a coach outside of KW. I hired a multifamily coach that taught me and my husband how to put together the group purchases, how to analyze, how to lead these investments. But the point was how to accelerate your journey in multifamily. And within 1 year of being in the coaching program, the multifamily coaching program, we had bought that 180 unit. So we did get formal education on how to do this back in 2017. And we are still in that same coaching program. It's like a high producing agent still has a coach. Even though I'm a successful apartment investor, I still have a coach, and I still surround myself with peers and people who have done this for longer than I have, to make sure that I am on the top of my game. And then, do I teach others how to lead? I do not typically teach others how to lead these investments, but I will absolutely tell you about the mentor program and the education program that I did, because the only thing I can recommend is to do the same thing that I did, which was go through that program. Any other questions? I know we are just a couple minutes shy of 3 o'clock, and I'm very happy that I'm respecting all of your time, and we're going to be done by 3.
Hey, Emily. My name's Emily as well, and I just had a quick, I guess, a few questions. But you mentioned during your presentation that there's like a different type of person that's investing in your North Haven versus your Eagle Point. Can you dive in a little bit about that?
Yeah, so every investment, every property that we buy is its own individual investment. So let's say you wanted to invest, you invested in North Haven, You could absolutely invest in Eagles Point if you wanted to, but nothing like North Haven is its own LLC. It's its own business. If it cash flows more that month, we can increase, we can do more distributions. Eagles Point is a completely separate business, a completely separate entity. It has its own passive investor set. The list of passive investors is unique to that property. And so that's just what I meant by that, is that just because you invest in one deal, you are not automatically associated with any of the other deals.
Okay, awesome. And then my second question is, I know you said you have a pool of investors, obviously, that are going into these properties with you. But what happens, if you have someone that is investing in a property and they get, let's just say, cold feet and they back out or something like that? What protection do you guys have in order to still go through with making that purchase, right? But knowing that this other person dropped out, or, going forward, maybe, not having that trust established with a person of, hey, are they actually going to follow through, with even this next project, right? If they were interested in that.
Yeah, and that happens more so when we're raising the funds. Let's say somebody, they raise their hand, they say, I want to put in 50K, they start filling out the documents. Let's say they even sign the documents, but then 2 days later, their husband loses their job, or something happens, or life happens, and a big event happens, and they have to come to us and they say, I know I already signed the paperwork, but I need out. And we haven't, and at this point we haven't closed yet. Like they haven't sent their money in. They have, they've signed, which is it's technically legally binding, but I mean, we're not gonna, if life happens, and we understand that. So there have absolutely been cases where we have said, okay, let's cancel the documents. You can come in the next time. There's usually a good reason for it though. Now let's say we've already closed, and then an investor comes to us and says, I want my money back. It's not that easy. This is money that you want to set aside for investing, but there is wording in the operating agreements, in the LLC docs, that spells out how that process is handled. And basically the lead sponsors, we have the first right of refusal if we want to buy those shares from you. But there may be a case where we say, I'm sorry, you have to stay in. It depends on, it's all situation dependent, but it is spelled out in the LLC documents.
Excellent. Thank you. I appreciate you answering my questions.
Yep, absolutely. I can take one more question before we wrap up. Okay, well, I invite you to schedule a call with me. I really look forward to meeting all of you. And I encourage you to start your passive investing journey, because it takes a few years to really see the results. So the sooner you start, the sooner you're going to see results. And whether it's with me or somebody else or whether it's that rental property, I encourage you to just start. Make this the year that you buy your first passive investment. And let's see, I think I got one more. Okay, nope, no other questions. We are going to wrap it up. Thank you all so much for coming today, and I look forward to meeting all of you in the future.